Bright lights.
Good morning. I'm Brian Trelstead, a partner at Bridges Ventures, and last year at SOCAP had the privilege of introducing Deval Patrick of Bain Capital and Deborah Winchell of BlackRock, two mainstream institutions that were starting an impact investing strategy at scale. And over the years at SOCAP, we often hear about the scale of the companies that we invest in, companies like D-Lite or Revolution Foods, and what it takes to scale them to solve the problems that we're investing in them to solve. But too rarely do we hear the story of the middle link of that chain, the fund managers who collect the capital that is growing and invest in the companies to finance their growth. My own firm, Bridges Ventures, started in 2002 with a $60 million fund just to invest in businesses located in underserved communities in the UK. But since then has raised roughly $1 billion with an expanded footprint to include impact real estate, new fund products like social impact bonds, and a broader geographic footprint including investments in the United States. So this year I'm joined on stage by three fund managers who've shown real persistence in growing their funds, investor by investor, investment by investment, and fund by fund to achieve scale. I'd like to have you welcome Nancy Fund, founder and managing partner of DBL Partners, Maya Chorngel, co-founder and managing director of Elevar Equity, and Dave Kirkpatrick, co-founder and managing director of SJF Ventures. Over the next 20 minutes or so, what we'd like to do is share their journeys to scale, some of their founding stories, the challenges along the way, and where they plan to go from here. So thank you all for joining me. Nancy, starting with you, you just completed a $400 million fundraise, but DBL started way back in 2002 as the Bay Area Equity Fund, a partnership between the Bay Area Council and JP Morgan. What convinced you at the time to leave JP Morgan for a small startup venture fund focused on the Bay Area?
Yeah, a good question. And before I start, I just want to thank the SOCAP team for another wonderful conference and for all that you do to help our field grow. And thank you, Brian, for bringing us together on our favorite topic. Well, when we started the Bay Area Equity Fund, I was an employee of JP Morgan. I had worked at a predecessor firm that had been acquired by JP Morgan, a company called Hambrecht & Quist. And I'm really probably the most unlikely entrepreneur on this panel because I worked at that firm for over 20 years and thought I always would. And so our first fund started as part of JP Morgan. And then when Jamie Dimon became the CEO of JP Morgan, he began to look at the third-party managed funds within the bank and felt that they were and this was a precursor to what we all know now, that banks aren't really in private equity. But he began to want to kind of spin out those firms. And so it was, necessity, the mother of invention. I didn't have much of a choice. And so I gradually got comfortable with the idea of spinning out. And so we spun out in 2008 to raise our second fund. And what happened is, and I think a lot of entrepreneurs feel this, is that the minute we did it, I was like, wow, we should have done that years ago. This is so great. And one of the most important facets of going it alone, and that makes you put up with the fear and the uncertainty and doubt that when you go out on your own, is that you now have a voice that you can speak about anything, and without having to go through, PR review and make sure that you've gotten your script in front of someone else. And that's completely understandable that big banks would have that protocol. I'm not complaining about it. But if you want to give full expression to impact, you've got to have full expression of your views and be able to help people by telling your story. And so that turned out to be very important to us in terms of our mission, not just to do well with our own investments, but to help create a new field.
And Maya, you just raised a $74 million third fund, and you're investing at a global scale, which I know from my time at Acumen Fund is quite challenging. When you started Elevar, your first fund, I think, was $24 million. What did you think was the right scale for the strategy at the time and now?
Yeah, interestingly, when our first fund was started, the original target was to raise about $15 million. We were lucky. Most of the investors were individual investors, and Omidyar Network was a big contributor to that, but we ended up with $24 million. We were thinking we would invest in 15, 16 microfinance institutions in the emerging market. So this was a microfinance-focused fund. It was the first emerging market microfinance fund that had a very concrete objective to achieve both risk-adjusted commercial market return in addition to creating enormous amounts of financial inclusion for the poor by scaling microfinance. So 15 million became 24 million, which we thought was big. 15 companies actually turned into 7 companies, which was quite a change. And what we found in the first sort of 2 years of life of that fund was the market started to take off much faster than we had originally anticipated. And I think that's been, sometimes in the impact investing world, we feel that time moves very slowly. But if you look at it over a broader spectrum, things have moved actually quite quickly.
And speaking of time, Dave, it's been 20 years since you guys launched SJF as a $17 million community development venture capital fund focused on job creation. I think your last fund 3 was $90 million. You have plans to raise a bigger next fund, but how did you get here from there, and how did you persist?
Well, I didn't think I was going to be the oldster on the panel, Brian. We started Sustainable Jobs Fund in '99, and I had been a solar and recycling entrepreneur, and I co-founded it with the venture capitalist Rick DeFew, who'd already done very well in venture capital. And so it was at that time, welfare to work era, late '90s, deep job creation mission in urban and rural areas that needed it. And really our evolution from 17 to 28 to 90, our next fund should be about 100, 120, has been kind of both a strategy change to rebranding the fund, SJF Ventures, and focusing less on job creation as the output, more on sort of deep positive impact as part of the DNA of the business model. And so supporting great companies like Vital Farms and Xtracker, and we've done with TBL and many others. And so it's been from CDFI, the first 2 funds, Impact Investment SBIC, unleveraged for the 3rd fund, and then just a pure limited partnership for the 4th fund. And also, really, our formation of the SJF Institute, which merged with Investor Circle to support early stage entrepreneurship. Just had a great announcement yesterday, folks heard from Bonnie about that. So it's been an evolution of how to figure out a strategy where we can achieve above market financial returns that drive deep impact. And it's getting the team right, too. About the strategy, the team enhancing deal flow, broader geographically, we're now Durham, New York, and San Francisco. And then, really finding the limited partners that match up with that and diversifying our limited partner base.
So in each of your journeys to scale, what has been the limiting constraint? Has it been access to capital? Has it been talent? Has it been opportunities to invest in? Quickly, each of you, what do you think the rate limiting factor has been?
Well, I think we've all grown in steps, and so I think that we've been able to get the capital we need because we grew over, at least for us, 10-year period. And the talent is certainly there. I mean, there's so many people that want to work in this field. That's one of our missions, is to grow the field so that people can have jobs in it. So I guess I don't see those constraints. The constraint I see is that we are changing the world, and there are a lot of incumbents and traditions out there and the lack of transparency that get in our way. And so it gets messy, it gets bumpy, and you have to be in it for the long haul. I mean, I was just reading the New York Times yesterday, and that story about how the sugar industry did research to point the finger at fat instead of sugar. That just kind of sums it up. I mean, our Revolution Foods investment 10 years ago, I can't believe it was 10 years ago, but we knew that kids were drinking too many sugary drinks, getting too much sugar in their lunches. I mean, we knew that a long time ago, and yet no one really cared or believed us or thought it was important. And so, a decade later, to see a story like that in the New York Times is really important. But you have to have a thick skin, and you have to really be in it for the long haul, because we are disrupting some age-old industries that some of them that haven't innovated, for a century. So that's kind of what gets gets challenging.
Maya?
Grit is really important. I think that fundraising is challenging for a lot of the GPs in the market. We spend a lot more time than we would like to on fundraising because there is no objective definition of impact. The vocabulary is still emerging, and there are a lot of people in this room who are huge contributors to helping to define impact. But trying to find the right investors to convince them that you're doing great work in the field and to develop the vocabulary around that, to do the hard work, to convince them to let them, to have them give you their capital with you behaving both as a fiduciary of their capital but also doing good in the world. It's very tough, and those of us who've stuck it out and gone to countless meetings and shaken hands and kissed babies and kissed frogs, I mean, it's a lot of work, and we'd rather be out there investing in the field, but you've got to do it, and it takes a lot of grit to do that.
They've covered it well. I think we can move on. Yeah,
All right.
no, I agree.
Good. Well, then sticking on
I've
the
kissed a lot of frogs.
Yes.
Sticking on the fundraising theme, Nancy, in raising the $400 million fund, I'm curious about two things. First, has the nature of your investor base changed, and have you seen, from the coalface of raising capital, changes in the composition of people allocating to impact? Is it moving from a tiny little sleeve to part of their mainstream allocations? And second, has your success changed how investors approach impact investing? I'll start with you and ask each of the three of you that question.
Absolutely a change in our LP base over the 12 years or so that we've been at this. Like David, we started with a lot of CRA money from banks and then some PRI money from foundations, which now we have really neither. I mean, we have a few banks, but of course it's become very difficult for banks to invest in venture funds with the Volcker rule. But that was our beginning. It was critical, and in the second fund, we saw pension fund. We'd had horrible timing. Our first fund was after the dot-com demise. Our second fund was 2009, right after 2008 bank troubles, and so we lost many of our banks in Fund 2. I mean, you can imagine, oh my gosh, where our LP base is evaporating. So luckily, the public pension funds became a much bigger part of our base in Fund 2. And then in Fund 3, we've got really everyone. Banks, just a very tiny part, but the family offices, which we had all along, and foundations, have just become a huge part of what we're doing. And very happy to say we finally got endowments in Fund 3, which we've been trying since Fund 1. So that was definitely a delayed gratification, but wonderful to see that come in. And now strategics, a lot more corporate investors, a lot more international investors. So when you look at the pie of LPs, it looks very similar to a traditional venture capital firm now.
Dave?
Yeah, no, we've gone through the same evolution as well, and I think it took some early leaders, the Heron Foundation, others, and moving the consultant world to the Cambridge Associates, the Mercers, all of these, that were gatekeepers a few years ago and have now developed mission-related investing practices. And they're getting demand from next generation inherited wealth and entrepreneurs, women investors often, and then they're coming to their advisors saying, I want a reliable fund with deep impact, and they look around and some with a track record, right? And so there aren't that many. They're developing more, and so we're seeing gratifying demand for our fourth fund now, in a way that when I raised our second fund, it was a long process because we'd gone through strategy change, rebranded the fund, and this even impact investing as a term wasn't really out there yet. It was community development venture capital, or is it venture capital? Are you sacrificing? All of those discussions. We had a gratifying, we're talking about pension endowment, we had a pension endowment investor in our third fund at about $4 million, and they were extremely skeptical on the impact element and grilled us. I remember in the kind of a fancy Harvard Club thing in New York. And we went back for our fourth fund, and they're just like, they're so sold on the returns go with impact. They're asking me all about the impact now. It was great. And they tripled their allocation to our fourth fund. And said, okay, we're getting there. We're getting there. Good. So it's happening.
And how do institutional investors view a sub-$100 million emerging markets venture fund?
Yeah. It's a great question. It's not easy. The first fund that we had, the $24 million fund, had 97 investors, mostly individuals. By our second fund, we had narrowed that to about 15, 16 investors. The institutions started to come in at that time who had very special allocations specifically to impact, or what, we raised our second fund also during the financial crisis, and it was when the term impact investing started to appear. Third fund is a very similar story, a mix of institutional investors who were the early catalytic starters in impact investing, as well as family offices and individuals. But at 74 million, there were a lot of institutional investors who we wanted to go see, some of the larger endowments, who said, I need to write, a $50 million check minimum, and I need to be less than 20% of your fund. So I can't even talk to you if you're, not over 250 million. And I think, there was some news that came out on Monday about a partnership between Elevar and TPG. And this is one of the things about raising impact funds at scale. It's a very, very careful journey that we have to go into as an industry in the next phase as we continue to scale the industry, but having funds that are much larger enables institutional investors like the larger pension funds, like some of the folks that are coming into my colleagues' funds over here who are more domestically focused. They need size and scale to be able to even look at you, and so our hope is that this will open, the doors to more institutional investors coming into the market.
Right.
And just a quick, we didn't answer the second question. I think we all experience that our LPs that have been with us, in our case from 1, 2 to 3, they have grown along with us, and in many cases written larger and larger checks, and just so grateful. And I'm sure many of them are in this room to take that flyer in that first fund when no one knew what this meant and there was no track record, out of a sense of purpose and diversification, and then to see that it's actually working. I think our LPs have been educated, as we have, that this is a very, not just a interesting way to build your alternative asset portfolio, but one that has a huge amount of potential.
And many famous Sand Hill Road venture capital firms insist on only investing in businesses where they can drive to the board meetings. Each of you have offices in multiple locations, 3 offices around the world, 3 offices around the country, San Francisco, Palo Alto, but investing nationally, investing globally. How have you guys gone about building and maintaining culture? And more importantly, on the question of impact, as you add team members, you might be joining, having folks join the firms that are sophisticated investors, but the art and science of evaluating something for impact. How have you built that culture around impact in national and global firms?
Yeah. Well, we started, as you mentioned, with the Bay Area Council, a regional business group here. We were partners, and we had a not-for-profit that helped us in that first fund implement what we call our second bottom line programs, social job creation, all kinds of environmental stewardship programs. In the second fund, what we decided to do, and it worked, but we said, well, we want to have control over this. We want to elevate it. We want to really make it our identity. And so we brought that in-house. We hired Lisa Hagerman out of the More for Mission program at Harvard Kennedy School, and who had written her thesis. I mean, I met her when she was writing her thesis about double bottom line investing on the part of pension funds. So that was a big change for us to bring that in, to have a PhD level professional run that for us. We're all involved in it. But it was core to our culture, and it's been super important because it allows us to have the latitude, have the bandwidth to build the second bottom line practice as opposed to have it as an appendage. And so, I mean, there are all kinds of ways to accomplish this and all kinds of models that can work. But for us, it's in our DNA to keep impact close and to really make it part of our everyday life.
Yeah, we have a similar story there. So culture in org, especially in an international context where we have an India-based team, we have a Bogota, Colombia-based team. We hire very carefully, and we hire people who have the skill set that we need, which is usually around investing finance, but they have to have a very demonstrated commitment to impact, very clear and very evident on their resume. They have to have shown personal sacrifice to have done impact. And we do have the opportunity to bring our team together somewhere in the world, usually once every year and a half. And the most important experience for all of us together is going out into the field and seeing the work of our companies. And it's that field experience and that walking the slums of Bangalore, or walking through the rural villages, outside of Peru, that is critical to us, both in evaluating entrepreneurs who we're going to back, but also in terms of evaluating our own team and building a culture and a bond amongst our team members. Impact is obviously at the core of that. Within every investment that we make, we're very serious about calling out the impact that we feel that the companies we invest in will create. What we would love to do going forward, and is a big initiative, is being a little bit more data-driven and scientific and quantifying impact better. There are a lot of us who are doing work in the space also to not just sort of talk about impact in the abstract, but to try and get a little bit more scientific about what that means, what are the real outcomes that are being created, and we call that out at every part of the investment process and every part of the portfolio management process and through the exits. And that's absolutely critical, but we're getting better at it over time because we're just getting, the whole field is contributing to more data there.
Yeah, just echoing that, that's the core to our investment thesis as well. I think going back also to the geography, we started in our era, the beginning, the community development venture capital industry was very regional. So there was Pacific Community Ventures here, there was NYSEC and Boston Community, et cetera. So we started with the sectoral approach from Durham and Philadelphia, then Durham, New York, and San Francisco, sort of best-of-class companies wherever they are in the U.S. in this sector that's driving impact. And so it does mean we fly a lot, and we have companies in more than 20 states. And we tend to see that as an opportunity to support entrepreneurs where the valuations are a little more reasonable than around here, and they have great teams. They're building opportunity in Appalachia and other places. So that's been part of our culture, and we do invest here and have very successfully, but happy to do it around the country. That has forced us on the culture side we all physically get together for 2 days every month. We just had investment committee the last 2 days here. We have entrepreneurs present to us, and it is part of building that culture about, both the most successful companies we can back and how their business model and impact are integral to it. And similarly for us, Stephanie Neiman joined our team, who was involved in the development of GEARS, originally the Global Impact Investment Rating System. So in every investment memo, this is how the company's going to scale from 5 million to 50 million or 100 million. And here is how the impact of the business model, it's just so intertwined, but we talk about, and what can we do to leverage deeper, broader policy change through working with these companies. So.
And the final question, as you look forward, have you achieved the scale you want to be, or as you imagine a future for each of your funds, do you see doubling 10x growth or maintaining the kind of size you are right now?
Well, to be honest, the $400 million fund, it could have been larger. We had just a very good reception. We never thought we were going to raise a $400 million fund. It kind of happened, and we felt it was important to seize the moment and use that demand to show the world that, yes, impact has arrived and that this isn't some marginal tangential activity. So having said that, I come from a venture capital background that was much more oriented towards smaller funds. I've never raised $1 billion fund. I don't think I ever will. I mean, I like the sizing of smaller funds. Not that 400 is small, but so I think in terms of our growth, we're going to need to, rather than go from 400 to $1 billion. I think that we will try to diversify more geographically and perhaps raise some funds that speak to a geographic place.
I think for Elevar, we've been heartened by the pace in the emerging markets space in venture at how funds are growing. We're at 74 for LFR 3, LFR 4 maybe 100, 150, not much larger than that because for venture, smaller is better. I think that private equity can be larger, and there's certainly scope for that. I mean, when I was at Warburg Pincus doing private equity, 20 years ago, the fund I was working on was $5 billion. Could there be a $5 billion impact fund with, holding onto the table tightly a few years from now? I think there could be. Certainly, if you look into the market and the need and the capital that needs to be brought, there is need for a lot more capital than that, and what you need are responsible stewards of that capital who are serious about the impact but incredibly disciplined on the investor front, and I think we'll get there in the right way.
Right. I agree, and I think we can also think about scale beyond just capital under management. I mean, for our fourth fund, we're targeting similar size. Our third fund is 90, 100, 125, and there is certainly very significant demand, but we see the ability to move the needle on impact and returns, this sort of financing companies where we write checks of $3 to $7, $8 million, and where we can achieve returns in even a down market with reasonable strategic exits with aligned like Nextracker to Flextronics, which was a great deal for DBL, NSJF, and others. And so for us, we think about scale also. How do we drive policy change? How do we drive the market more? And how do we help others come along? I saw Impact America, a new fund just get capitalized here with $10 million. And so how do we mentor and build this field more broadly and drive deeper policy change in these segments in addition to deploying capital effectively?
Great. Well, thank you all for sharing your insights and the journey just to scale. Best of luck in your continued journey. Please join me in thanking Nancy, Dave, and Maya.
Thank you, Brian.
Thank you.